welcome everyone in our webcast audience. I'm Terry Maggedy, the chair of the Elder Law Committee for the Trust and Estates section of the Beverly Hills Bar Association. You should have received already your materials via email, and you're going to get your email regarding MCLE credit coming up after the program. And the first thing I do is thank our sponsors. Because that's who we owe everything to for these great programs that we're able to put on each month. And I'm going to introduce our first sponsor, which is Nancy Sanborn and the Sanborn team. Nancy?
Thank you, Terry. It's always been a pleasure to spend the past 14 years sponsoring this section. I have to say that you put on the most wonderful programs, and I think that you really should be given a lot of credit for all that. Thank you. They're great programs.
Welcome. And now our next sponsor, Orit Kadish. Orit?
Thank you, Terry. Hi, everyone. Thank you, Terry. Hi, everyone. I'm Orit Kadish, owner and broker of Geffen Real Estate. I'm excited to announce that I recently launched my first book, titled The Practitioner's Handbook for Probate Real Estate. It's available on Amazon. It includes step-by-step procedures showcasing various facets of probate real estate sales. It includes diagrams that visualize these processes. It also includes many best practices and strategies to ensure you maximize returns while mitigating liability. I'm happy to provide you, the practitioner, a complimentary copy of the book if you're willing to read it and provide your feedback and a review if you like it. Please text me if interested. My cell number is in the chat box. Back to you, Terry.
Thank you, Orit. And now for our next sponsors, I want to mention first, Marcine Klein, great escrow company and great escrow officer. I mean, I'm in the middle of a very complicated transaction with them now. And, you know, they would do a wonderful job, specialize in probate, estate sales, conservatorships, all the kind of thing we do in our section, in our committee. Glen Oaks Escrow. Also, thank you to California Title Company, a title company who again, another outfit that specializes in the areas we deal in probates, trusts, conservatorships, sales involving older people. Thank you, California Title Company. And our sponsor as well, Manufacturers Bank. So, and their information is right in front of you. Also a great outfit, you know, particularly in the trust and estate space. And right before I announce our program, I just want to share our next program, which is going to be April 26th, a speaker that we have pretty regularly. He's very popular because he's an excellent speaker. Barry Sykov is going to be talking about Medicare. Some people are nodding. Barry's really great. He's very knowledgeable and entertaining speaker. He's going to talk about migrating to Medicare and all sorts of sub issues relating to Medicare. So that should be very interesting, April 26th. And our program today, Doing the Right Thing, Managing Trust for People with Disabilities and older people. I have the pleasure of introducing a great team from Bernstein. I mean, what an outfit, what an outfit. And to have our speakers here today, Ashley Velategui, Jean Wong, who will introduce, you know, our group right before they speak, and our very own Andy Kushner, you know, who everyone knows Andy from the Beverly Hills Bar because she's like a long time, very active leader in the bar. I mean, the topic today and the expertise you have in front of you is so, I mean, it's so interesting and fascinating because really to talk on something like this, you really need a mix of investment expertise, fiduciary expertise, law expertise, and tax expertise. And I'm looking forward to learning a lot in the program. So for now, I'm going to turn it over to Jean, who I want to thank specifically for putting together this program. I've known Jean for many years, and she's just you know, a wonderful professional over there in Bernstein. And then she'll tee it up right afterwards for Ashley and Andy.
Hi, thanks so much, Terry. Thanks for inviting us to come and speak to the group here. And I just wanted to take a minute and introduce the firm, Bernstein, to those of you who aren't familiar with it. We are an investment research and asset management firm. We've been around 50 odd years. Today, we've grown and we manage almost $700 billion, mostly for institutional clients like the World Bank, the US Treasury is our client. We manage big chunks of Intel's retirement, CalPERS money. But the thesis remains the same, which is to use institutional quality research and advice and use it for private clients. So that enables us to be a legal fiduciary. Like many of you on this call, we at Bernstein are legal fiduciaries to both our institutional and private clients. And so as a fiduciary, research and planning really lie at the heart of all the advice that we give. And of course we manage money, but I mean, before we even start to manage money, we take a deep dive into understanding a client's situation. So without further ado, I'd like to introduce two members of our team. Ashley Velategui is coming to us from Seattle. She's a 13-year vet of Bernstein and a chartered financial analyst. Andrea, but she's a UCLA and USC law grad. She also has a master's in tax and has been at Bernstein over 5 years, I'm happy to say. So take it over, Ashley and Andrea. Thank you. Oh, by the way, if any of you have any questions afterwards and want us to do a deeper dive on any of your situations and do some analytics, my name and phone number will appear at the end during Q&A. You can contact us and we can run these complementary analysis for your client and situation as well. Thank you.
Thanks, Jean. And thanks for having us today. Ashley and I are delighted to come and talk to you about managing trusts with definitely a focus on disabled and older beneficiaries. I think in general, though, just taking a step back, I think being a fiduciary, acting as a trustee is a challenging job with a lot of responsibility. But right now, I would say it's especially challenging. We've got a lot of economic uncertainty. Global yields are low, which could potentially limit future income. Projections for the markets and equities are lower. I would say they're muted in a way that they haven't been in the past. We're living with a lot of tax uncertainty. We've got, tax and estate rules that are supposed to expire at the end of 2025. We've got a new administration, which means that there's talk about either accelerating those changes or maybe, even implementing new ones. So that's difficult to plan for. And then the overlay of all of that is that people are living longer. So the trust that we established 10, 15, 20 years ago for beneficiaries have to last longer. So we have to be thoughtful in how we look at those assets and the timeline over which they need to last. So today we're going to look at some of those things and really through the lens of some of the major duties that a trustee has. There's unless a trust document opts out of it, there's a duty to diversify. That's the prudent investor rule. There's a duty to treat beneficiaries impartially. And that can be a challenge when you're dealing with marital trusts, especially marital trusts where the surviving spouse is contending with children not of that marriage. And so we're gonna talk about that today too. With that, there's the power to adjust between principal and income. There's also, looking at taxes and the overlay of all of that. So today, what we thought we would do in covering all these issues is really bring them to life by showing you some case studies about today's environment. We're going to start with investment allocations and how looking at the allocations can support lifetime spending. We're going to look at a case study, a Q-tip case study, so what I just referred to. We're going to talk about planning for special needs beneficiaries and some of the challenges that can present. And then time permitting, we have a bonus case study that I hope we get to that looks more at the income tax planning side of managing trusts. And when does it make sense to have a distribution out of a trust instead of paying the taxes at the trust level? So our plan is to go through the case studies, and then I think we will have ample time for questions that you can submit either through the Q&A box or through the chat feature. So with that, as kind of our starting point, I'm going to invite my colleague Ashley to start us off. And Ashley, let's talk about investment allocations and how that can affect, the ability to support lifetime spending.
Absolutely. Thanks, Andy. So that's one of the questions that we are asked most frequently by the trustees and the fiduciaries that we are working with. And that is, of course, the utmost concern is to ensure that the funds are there to support the beneficiary with a high degree of confidence, and making sure that they get the allocation right to be able to do that with a high degree of confidence is critically important. Oftentimes, we see trustees and fiduciaries coming at it from the lens of providing as much stability as possible. So the default tends to be wanting to really lean into a very conservative allocation of all bonds, if not very close to an all bond allocation. And that's not always the right choice, particularly given the unique environment that we find ourselves in, as Andy outlined a couple of slides ago. So to really bring that to light, we wanted to share this case study. Again, this is for a support trust where, as you can see on the top, the grantor's intent is really just to ensure that they are properly providing for the current beneficiary and ensuring that there's ample assets to provide financial support for them for the duration of their life expectancy. The trust in question is worth about $5 million. There are no substantial personal assets outside of the trust. The beneficiary is 70 years of age and has a fairly normal life expectancy with about 20 years that we need to plan for. Again, the trustee, as I mentioned, was coming from that initial conservative place of wanting to start with a allocation that was heavily tilted towards fixed income and bonds. Primarily because I think oftentimes when we're thinking of providing spending support and income to a beneficiary, we think about investing in assets that produce or traditionally produce a substantial amount of income. So bonds tend to be sort of the initial go-to. This beneficiary needs to spend about $215,000 per year after taxes adjusted for inflation. And the primary goals were really to provide, distribution support for the beneficiary. Sustainability of the distributions is critically important, as well as stability of the distributions. Andy, if you'll take us to our next slide. So the issue that we have, again, with this assumption that we're going to invest in an allocation that's going to be able to produce sufficient income and meet the spending requirements solely based on an income distribution from the trust, there's actually two problems with that in today's environment. And the first is just simply the fact that because yields are down, projected income has declined really across all allocations, but most significantly for those very traditionally conservative allocations that tilt heavily into bonds. So what you can see on this slide is for a $10 million trust, the purple diamonds at the top across the page represent the amount of income you could expect to receive from these allocations, ranging from all bonds on the left up to a 60% stock, 40% bond allocation on the right. And that's what we've experienced over the last 10 years, something in the neighborhood of, $215,000 up to $245,000. The blue bars below that represent our expectations for the same allocations going forward based on current conditions. And what you'll notice right off the bat is there is a massive gap, right? As if we just take, for example, on the left-hand side of this page, this all bond allocation, historically, over the last 10 years, you could have expected to receive $245,000 worth of income from that allocation. Going forward, $48,000, right? So very, very big differences. And again, that's simply because of the current yield environment that we're in. Now, more income provided on some of these other allocations. So when we tilt all the way up to a 60-40, 60% stocks, 40% bonds, it's better, but it's still lower than it's been historically. So looking at providing financial support to the beneficiary by only considering an income distribution may not be sufficient in all cases. Not to mention, and if you'll take us to our next slide, not only is income down relative to where it's been, it's not a very reliable standard for defining trust distributions. Income is incredibly variable because it's so sensitive to things like the interest rate environment. And we've shown that just by way of example by looking at, for $1 million trust allocated in a 60% stock, 40% bond allocation, the amount of income that trust would have produced over time. You look all the way back to 1980, and you're talking close to an $80,000 income distribution, which is a pretty healthy distribution. Fast forward 30 years to 2020, and that same allocation would only produce $18,000 worth of income. So yes, we know that we're in a particularly low rate environment today, but if you just look over time, right, this is a figure that's constantly changing. So not only do we have to worry about, is it producing enough income if we're only going to focus on distributing income to meet a spending need, but also how consistent is that? And the answer is not very. So we may need to think about another way to provide spending support to a beneficiary. So rather than looking at solely focused on an income distribution, we should be focused on more of a total return methodology, where spending needs can be also met, not just from the income produced by a trust, but potentially dipping into principal and recognizing capital gains along the way as well. So Andy, if you'll take us to the next slide. Oftentimes the concern that this then brings is, okay, if I have to focus on a total return methodology, I may then need to lean more into stocks, and I'm worried about volatility of the corpus, and will that get me to a place that will ultimately meet my beneficiaries' needs? And the answer is, yeah, it might, if you get the right mix of the allocation. So as you can see on the left-hand side of this page, what we're showing here is the range of returns that a trustee could expect from 3 allocations: all bonds on the left, a conservative 1585, and a slightly more moderate set 2575, 25% stocks, 75% bonds over the next 20 years. While there's a range around the expected returns, if we just focus on the diamond in the center of each of those bars, you can see that by leaning slightly into stocks, again, we're not going very aggressive, but just up to a 2575, we can increase the expected return in that portfolio from 1.7 to 3.2%, almost double. Of course, the concern is that that also means potentially doubling the risk in the portfolio, or at least increasing the risk. And what you'll notice on the right-hand side of the page is we've attempted to quantify the volatility and the risk associated with those 3 allocations by looking at the probability over the next 20 years of experiencing at least one 10% peak to trough pullback in the value of the portfolio. And you'll notice that going from all bonds to a 2575, while it increases the return in the portfolio, it doesn't actually change the volatility, because you're getting the benefit of diversification, that stocks and bonds tend to move in different directions at different times. And the bonds are serving to protect and offset some of the added volatility with stocks, while you've got the stocks in there that are helping to juice the returns. So very meaningful to actually, widen the scope and look at potentially a more optimal allocation. Andy, if you'll take us to the next slide, we wanted to, again, go back to revisiting our case study with that data in mind, where we think again about the trustee whose needs to provide $215,000 of inflation-adjusted spending support for the beneficiary of their $5 million trust. We evaluate those 3 allocations: all bonds, 1585, and 2575. You'll notice that in all cases, there is a very high probability that they can meet the spending need. But as you tilt into that 2575, the odds of meeting those distributions sustainably increases from high 70s into low 90s. So even more reliable and sustainable of distributions, while also increasing the expected amount to be left in the corpus at the end of the horizon that we evaluated. So allocation is a critical decision. We, again, often find that people have sort of a bias towards a very conservative income-focused allocation. And given the current environment, that's not always the right solution. And so we just need to be more open-minded to really evaluating the choices on the table to find what's going to best meet the beneficiary's needs.
Thank you, Ashley. And by the way, apologies to everyone on the line. Midnight, the rescue puppy in my home tends to be my co-presenter at times during these presentations. So if you hear woofing in the background, clearly she has some opinions about allocation and income for beneficiaries. But let's switch gears now and talk about, I would say, the thing when I was in private practice, the fact pattern that came up quite a bit and tended to give pause is, how do you manage the needs of the current income beneficiary, the surviving spouse, and the remainder beneficiaries when you're dealing with a marital trust? So we thought we would bring that discussion and that conversation to life by sharing another case study with you. So we've got Janet and Henry, who were married 20 years ago. It was a second marriage for both of them. Henry passed away about a year ago. Henry had two daughters, Jenna and Natalie, from his first marriage. Janet also has a son from her first marriage. In his estate plan, Henry left Janet with a $10 million marital trust to help support her during her life, with the remainder designated for his daughters. Very common plan that many of us see. Janet's also got a $2.5 million personal portfolio, but she kind of sees that as her safe money. She preferred to spend that only when the trust distribution from the Q-tip trust doesn't meet her spending needs. What are those needs? Janet spends about $310,000 after income taxes. And that number throughout our analysis that we're going to show you is inflation adjusted. So when Janet came to us, one of the questions posed is, how do we treat the income, Janet and the remainder beneficiaries, Henry's daughters, impartially, as a trustee is tasked to do, assuming that Janet, is 60. So, actuarially speaking, it's likely that she's going to live at least another 30 years or more. So how can the investment allocation and the distribution policy consider both her needs and the desire to provide for those daughters? So we looked at, the first conversation is, how do we think about this in terms of the allocation for that trust? And for Janet and for really everyone involved, they looked at it and said, okay, what we consider to be a moderate allocation of 60% equities and 40% bonds was appropriate for this Q-tip trust, and it would satisfy her spending. In most markets. The thing that we struggled with, though, here is, if you looked at the breakdown of, accumulated distributions for Janet over the next 30 years versus what the remainder would be projected, what you see, that's what we're showing on the left side. And in the diamonds, as Ashley had talked about before, represents the median case. In the median case, we'd be looking at about $9 million of accumulated distributions for Janet over the next 30 years, with a remainder at her death, assuming that happened at the 30-year mark, of $6.3 million for Henry's daughters. And so if you look at that breakdown between Janet as the current beneficiary and the Henry's daughters as the remainder beneficiaries, it was about 59% of that trust was allocated to distributions for Janet, and 41% was allocated for the daughters. And so as a result, this distribution policy really favored Janet over them. And so no one felt great about that, not the least of which being the trustee, who had to manage that and had a duty to treat these beneficiaries impartially. So we thought, okay, what are ways that we could look at this allocation, provide for Janet, but also arrive at a more even distribution between Janet and those remainder beneficiaries? So one thing that was considered was a unitrust, is converting that income interest to a unitrust for Janet. And so what we looked at it as, we're looking at a $10 million pool to start, to achieve that $310,000 spending need. That would require roughly a 3.1 unitrust distribution. By the way, in California, I know many of you know this on the call, but our statutes allow a trustee to convert an interest to a unitrust, and the band is between 3% and 5%. So this would fall within what California allows. So we said, okay, if we converted to a unit trust distribution, so instead of, the 3.1% was distributed to Janet annually for the 30-year period, how would that change the results? And in that case, in the median case, and this is what you're seeing on the left side of this page, we'd expect accumulated distributions for Janet of 8.1 million and about 7.9 million remainder for the daughters. So the good news with a unit trust is that it in this case, it provides for a more equal distribution overall between the remainder beneficiaries and Janet. And so from a trustee's perspective, when you're looking at the duty of impartiality, this comes closer to that mandate. As we all know, though, the downside of a unit trust distribution is that you don't have, you can have wild swings in those distributions out to the beneficiary. And so for a beneficiary, especially like Janet, who was really relying on a certain amount being distributed from that trust, to have wild swings can be very difficult to manage. And so we actually have an historical illustration here about how the volatility of markets and asset values can impact a unit trust payout. And so we looked at a period here. Let's assume we looked at our starting point in 2008. So our first year, we have our $10 million trust. Janet receives a $310,000 distribution. Great, except for, as we all know, 2009, very challenged year in the markets. If we had a 25% decline in the value of the trust, now her unit trust distribution falls concurrently. And so now we're looking at a $232,000 distribution for Janet, which is far less than her expected need, which would mean in this case, Janet would need to pull on that other portfolio. And yes, she had the available funds, but that can be difficult to manage. And as you see, as you go forward to 2014, as the markets rebounded, she would be looking at distributions in excess of the $310,000 towards the end of that period in 2014, and a higher value of her trust. So one could argue, in the main, over an average period of time, Janet was, receiving the distributions that were intended. But if you have challenged years, that can be really difficult for a beneficiary to plan for. So we thought, okay, what are other ways that how could we smooth the ride really for Janet and provide a little more consistency for her? And there are really two ways. One way is, a smoothing, which actually the California statutes provide for, where instead of basing the unit trust distribution on 1 year, you do it on a blend of years, so that if we had a blending, on the prior page, there would not have been as much of a decrease in the distribution because the value would have been based on, on the average of those years. So that's one way. A second way, and often we see these provisions work in tandem, is setting floors and ceilings. And what I mean by that is we set a 3.1 unit trust provision here. What we're showing you one is with a 3-year smoothing provision, but we add a floor that says the payment, the distribution out can only go as low as 85% of the original unit trust amount. And we put a cap on it too, where at the high end, we can only go up to 115% of that amount to kind of narrow that band so that there's more consistency of distributions. And also to prevent, with the ceiling, what does that do? That protects the remainder beneficiary. So we don't have these wild increases of the distributions as well. And so what you see in the middle here is if we were to employ a ceiling and a floor here, on the left side, if we had a distribution with a 3.1 unit trust, without any special provisions, we're looking at a probability of a of a 20% drawdown, a decline in that distribution, there's a 92% chance of having a 20% drop. So that's pretty significant. If, however, we have a smoothing policy and also set some ceilings and floors, that decline, that chance is reduced to 32%. So that's significant. And especially for a beneficiary who is relying on these distributions, can be critical in helping them manage their cash flow. So what does this mean in terms of, let's say, we imposed, 3.1 unit trust and we have the floor and the ceiling. What does that mean over a 30-year period? Now, where do we look in terms of the split between Janet and the remainder beneficiaries? Over a 30-year period, in the median case, Janet would have accumulated distributions of about 8.3 million. The remainder value would be about 7.4 million. So what that means in terms of the split is what you see on the right, is it would tilt a little bit back to Janet. It would be 53% for her versus 47% for the remainder beneficiaries. So there is a modest shift, but what it achieves is more consistency for Janet. And so for this family, after conversations between their estate planner and also us, because this is actually based on a real case that we had, the decision was made to go with this strategy because the feeling was everyone's needs were met here, and it was a better result overall. So why don't we switch gears? Ashley, we've been talking about older beneficiaries here for our first couple of case studies, but we also work quite a bit with families who have special needs family members and planning for them and the challenges attendant to that.
Great. Yeah, let me happy to take you guys through this next case study, which at the premise is not dissimilar from the Q-tip case study that Andy just went through. As this is a family who has 3 children, one of whom has special needs, and they are going through the process of reevaluating their estate plan. Their intent is to provide an equal legacy to each of their 3 children. We know when it comes to the world of special needs planning that fair is not always equal and equal is not always fair. However, in this case, this family has determined that given the amount of the resources that they have available and the nature of their special needs child's disabilities, that an equal division from a financial perspective, an equal division of the estate is their ideal. So looking to leave a third to each of their children. Now, as specialists in elder law and special needs planning, folks on this call, I know you are probably all very well aware of the fact that when we are talking about leaving substantial resources, or substantial is a relative term, anything above $2,000 to a special needs beneficiary, we have to be concerned about the impact that might have on their ability to collect public benefits. And so this family has done the due diligence on that aspect, and anything that is left to their special needs child will be funded into a special needs trust. But the makeup of this estate is somewhat unique. Linda and David are in their 60s, and they have a $33 million estate, so they have substantial resources. About half of that is in liquid taxable investments. They have a fairly sizable Roth IRA of about $500,000, and they have $18 million in low basis real estate holdings. When it comes to thinking about how the special needs trust would be funded, an equal division of each of these assets to each of their 3 beneficiaries very, very likely does not make sense. We know that real estate held in a special needs trust can be complicated. It may not provide the liquidity that a special needs beneficiary needs at the time that they need it. And so to account for that, this family had opted to actually target all of their low basis real estate to their 2 neurotypically developed children, along with the Roth IRA, and source any distribution to the special needs trust solely from the liquid assets. This case study actually was done a number of years ago at a time when leaving an IRA into a special needs trust would have been fraught with issues. As a result of the Secure Act, that actually is looking like a more promising idea because of the potential loss of the stretch, but the carve outs for disabled beneficiaries. However, even in that case, because this family is intending to leave the real estate, which is not necessarily a fully liquid or readily liquidable asset, to their other two children, the family may still choose to want to leave the Roth IRA to those children so that they can have access to some degree of liquidity in the event that it takes some time to divest some of this real estate. So we're going to go with that assumption for now. So again, in their current estate plan, the special needs trust will be funded from the taxable assets. The remaining assets will be split between their other two children. The problem with this plan is, again, at the time that this analysis was done, the combined exclusion stood at just about $11 million. As a result, depending on when the parents passed away, they'd be looking at a very significant estate tax. And that estate tax would very likely be sourced from the liquid investments, which would shrink the pool available to fund the special needs trust, resulting in a potentially very unequitable distribution of assets between the three children. One solution could be simply target more of the real estate into the special needs trust, but they didn't want to do that because, again, it causes issues with real estate. They didn't want to use the real estate for any lifetime gifting because it was very low basis and it would benefit by remaining in David and Linda's estate for a step up in basis. So the family was sort of stuck and they wanted to see, if we do nothing and carry down this path, where do we end up and what do each of our children get and how might we optimize that? So Andy, if you'll take us to the next slide. What we have on the left-hand side of this page is a snapshot of what David and Linda's estate looks like 30 years from now after spending $350,000 per year inflation adjusted. They're likely to have an estate that actually is still valued at about $33.8 million, about 14 in liquid assets, the Roth IRA worth 1.8 million, and the real estate we've assumed simply holds its value with inflation. But based on where the exclusion stood at that time, they'd be looking at a $9.2 million estate tax liability. Assuming that that's sourced from the liquid taxable assets, which is very likely the case, you can see at the bottom half of this table, that means that the liquid assets declined to just under 5 million, while the Roth and the real estate still provide a substantial amount of wealth. So if the estate was then to be divided, liquid assets to the special needs trust, divide the Roth and the real estate between the other two children, you end up with a very unequal distribution of wealth. Only about 20% of the remaining estate going to the special needs trust and 40% to each of the children. Whether or not 20% of this estate, roughly $5 million, is enough in the special needs trust was not the question for the family. They really wanted an equivalent distribution of wealth, regardless of whether or not the special needs trust was fully funded or not. So, Andy, if you'll take us to the next slide, what was considered in this case was actually committing a portion of the family's liquid assets to a series of 2-year rolling grats, such that the beneficiary of the grats was targeted towards, or the remainders of the grats were targeted toward the special needs trust as a way to start pre-funding the special needs trust in a way that didn't utilize any of the family's exemption, allowed them to keep that exemption so that they could fully shelter more of their assets for a step up in basis, particularly important because of the real estate, and hopefully end up in a more equitable distribution, not only because these grats are being pre-funded and so the special needs trust is being pre-funded, so it gets a bit of a head start on the other two children, but through the mechanism of reducing their estate through those grats, they're also lessening the amount of the future estate tax liability, which again should leave more liquid assets available to then top up the special needs trust upon their passing. So Andy, if you'll take us to the next slide, where we look at the results of this grat strategy, you can see that the estate 30 years from now is smaller because they were able to actually transfer $8 million without using any of their exemption during their lifetime. The estate tax liability has declined by nearly $4 million. And as a result, when you then divide up the remaining assets to the other two children, you end up with not exactly a third split, but much, much more close to the family's desired objectives. The special needs trust is funded with $8 million, and each of the other two children receives $10 million. So again, just we do a lot of work with special needs beneficiaries, thinking through the complexities in terms of what assets should ultimately be used to fund a special needs trust, and getting creative in terms of thinking about how it should be funded. Oftentimes, these trusts aren't funded until passing of the primary caregiver. And certainly there are instances where we should be considering utilizing some transfer strategies to pre-fund a special needs trust during the family's lifetime in order to achieve their objectives.
Thanks, Ashley. Well, the good news here is we have actually time for our final case study here, which talks about balancing income tax management and estate tax management, which I think is certainly a timely topic, especially this year with looking down the timeline of potential changes on both the estate tax and income tax regimes. But I know something that we deal with quite a bit when we're looking in whether to source distribution, spending out of a personal portfolio or whether to take distributions, is looking at both the tax position of the beneficiary, but also what it means to keep that income in the trust and have it taxed at the trust level. And I think we're all aware that as a general rule, trusts, irrevocable taxable trusts, bear income tax at in a compressed way, meaning that you reach the highest marginal rates much faster in a trust than you do as a single filer. And so on the left side of this page, we've got some of the thresholds between what the income tax position would be for a single filer versus a trust, where those thresholds come out. But what we thought would be helpful is to show it in real terms, if what it would mean from a tax perspective to have taxable income of almost 454,000, what that would look like for a trust versus a single filer. If we're looking at it, especially if we're looking at capital gains income here, for a trust, that trust is going to pay tax at a 23.8% rate, pretty much on all of that income. So we're going to bear income tax here of $105,000. There's a little bit of an exemption, but for the most part, it's almost a flat rate, 23.8%. However, for a single filer, you get the benefit of running through the brackets. And so as a result of that, that trust actually the single filer on that same amount is going to pay $69,000 instead of that $105,000. So there's a significant savings by having, all things being equal, if we can shift income at times from the beneficiary from the trust, that can mean an overall tax savings and more available assets for spending. So this is another page that again looks at the difference between and just another way of displaying the information, another resource for you as you're going back through our presentation. Really, the difference between a trust and a single filer, if you look at the bottom, the effective tax rates, is a single filer for capital gain income is paying a 20.2% blended rate versus the trust that is basically playing that flat rate. So something to bear in mind when you're working with beneficiaries and trusts of, what the differential is. The numbers as they get, that 2 to 3% difference can mean a substantial tax increase for the trust versus the individual beneficiary. So Ashley, why don't you take us through an example of how this works and how we think about this when we're managing the tax ramifications for a family?
Absolutely. And, of course, Andy, there is no one size fits all solution here. This is absolutely as in with many cases, it's truly isn't. It depends on the financial circumstances of the individual families that we're working with. But we will share the advice that we would provide somebody who had a situation that looks like this. We have Beatrice, who's 70 years old, has a credit shelter trust from her late husband. The credit shelter trust is valued at about $5 million, and she has a personal portfolio of $3 million. Currently, there's no distributions are being made from the credit shelter trust, and she's meeting all of her spending needs directly from her personal portfolio. Both portfolios are moderately allocated, 40% stock, 60% bonds. And again, she needs to spend about $120,000 annually, which is currently all being sourced from her personal portfolio. And generally speaking, that's the advice that we would give. Spend down the assets that are first in your estate such that you get the full benefit of the assets growing outside of the estate and being sheltered from a potential estate tax liability. So, at the outset, Beatrice is doing everything right in accordance with what would normally be the standard advice. The question, though, is there a way that she can reduce the taxes paid by the credit shelter trust? Because as Andy just went through, those trusts hit those top marginal tax rates very, very quickly. And how does the current estate tax exemption and the potential changes in the estate tax exemption impact how she makes this decision going forward? So just as if we start by looking at this next slide, we can evaluate what Beatrice's estate is likely to look like over time, taking into account where the applicable exclusion stands. So at the time that this analysis was run, Beatrice's estate was valued at $3 million. That's the value of her personal portfolio, knowing that the credit shelter trust is sheltered and currently outside of her estate. The exclusion stood at $11.6 million, which was well in excess of her estate. So no estate taxes would be due if Beatrice were to pass away today. And even if we take into account the potential sunset in the exclusion amount, dropping back down to $5 million, inflation adjusted in 2026, because Beatrice is spending from her portfolio and based on the modest growth of the portfolio, based on her slightly more conservative allocation, her estate actually declines over time and always remains fairly significantly below the amount of estate tax shelter she has by the way of the applicable exclusion amount, even after we account for the adjustment in 2026. So perhaps what that means is that her estate has some additional capacity to take wealth back onto her balance sheet and therefore reduce the amount of income taxes being paid by shifting income from the very high tax status of the credit shelter trust into the lower income tax brackets potentially of Beatrice's estate, where she can really benefit from the run up in the brackets that Andy went through a couple slides ago. So Andy, if you'll take us to the next slide, you can see how Beatrice's estate would change if we were to then start distributing all income out of the credit shelter trust into Beatrice's estate. Her estate then actually grows because she's pulling more money into it relative to what she's spending. But even in that case, that line in the middle, that light purple line, while it increases up to $5.35 million at the end of the next 20 years, it still remains below the amount of applicable exclusion that she has. So all of that can benefit from an additional step up in basis, helping to avoid additional income taxes. And it's fully sheltered from estate taxes still because she hasn't exceeded her exclusion amount. So what does this mean in terms of overall wealth that's been created for the family? And if you can take us to the next slide, we looked at two cases. On the left-hand side, we assume, what if the trust made no distributions to Beatrice? And on the right-hand side, what does it look like when we do make distributions? So on the left, what's in her estate after 20 years is about $2 million, and the credit shelter trust has 9.6. You can see how that balance shifts very dramatically where we start making income distributions. The trust assets decline by about $3 million. and consequently her estate increases by $3 million. Again, no estate tax consequences here because she's still well below the exclusion amount. And just to do the math for you, and if you move to the next slide, you can see that it's not simply a matter of shifting wealth from one pocket to the other. We actually have created an additional $400,000 of wealth solely by improving the nature at which the income generated by this trust is being taxed at, taxing it at the more efficient single filer rates for Beatrice relative to the very high tax status of the credit shelter trust. So when you look at the total amount of wealth in her personal portfolio plus what's in the credit shelter trust, again, by distributing all the income from the trust, we save on income taxes, better for all beneficiaries, and we end up with $12 million of net remaining estate as opposed to 11.6. So again, this isn't always going to be the case. Income taxes can be quite burdenful. However, a 40% estate tax liability, arguably worse. Again, depending on the nature. I know at California, we're kind of at a push here when you factor in state income tax rates on top of the federal capital gains rates. But it is something that you do need to evaluate the situation in full. We also need to be looking at where beneficiaries located, what kind of income taxes are they going to have when they inherit assets, how valuable is the step up in basis, are we triggering an estate tax liability by shifting assets back into the estate? So it truly is a complex calculus. It depends type situation, but one that we certainly can help evaluate and figure out what is the best set of circumstances given the facts of each individualized case.
Ashley, I was just going to ask, one of President Biden's proposals on the estate tax side during the campaign was to reduce the exclusion to $3.5 million. So I would imagine this analysis for Beatrice would look a bit different, and the decision points would change because at that point we would be looking at potentially creating a taxable estate for her at a higher rate.
That's right. Quite different, because then what you've done is you may have saved on the income tax burden during her lifetime, but you've subjected substantially more of her wealth to a 45% estate tax liability, which is very likely going to trump any benefit you got from saved income taxes along the way. So both have to be factored in.
Got it. Thanks, Ashley. And that actually brings us to just our concluding remarks. Bringing this all together, looking at how do you maximize income in a low yield environment, looking at the assets that you're putting in your allocation. So we're looking at a lot of REITs these days, a lot of alternative investments, but being mindful of income generation in the allocation is important. I would say if we can convey anything today is I think that modeling these days is really critical, and running the forecasts is really important. I think there are quite a few clients who get concerned with the markets and the market activity, especially with the volatility of the equity markets over the past year. There are clients that went either 100% in bonds or they went into cash, which in some ways can be even worse. And so what proper modeling can show is that even a slight allocation to the equities improves the performance overall in a long-term plan. Balancing, the interests of current and remainder beneficiaries. I think the unit trust distribution is one that I will admit I did not use it probably to its fullest potential when I was in private practice. I see it a lot more now, and it's something that I tend to suggest more now than I was in private practice, because I've seen the power of it and how it can really improve a family's experience. And then, the final point I would say is really balancing the estate tax versus the income tax implications of how you're looking at trusts and distributions. It's taking that 30,000 foot view of what this means for a beneficiary and also the family, and making sure that good decisions are made, taking into account all of those interests, I think is critical. So Ashley, is there anything that you would add to that?
I guess the last piece that I would add is, while not specifically on this page, is that all of these issues, while complex in their own right, are amplified when we're also talking about a special needs beneficiary
Yes.
who is relying on public benefits. Keeping in mind that the public benefits themselves, while modest, can, even for very wealthy families, can be critically important, because it may not just be about the dollars of the public benefits, but the access that qualifying for those public benefits can provide. And so again, it's just leveling up the complexity and creates an environment where the fiduciary's duty of ensuring that they're accounting for all of these different factors and providing for their special needs beneficiary of these trusts becomes even more critically important. And going through some of that modeling can be really helpful in, reassuring the family that they've taken the right steps and drafted the right estate plan and opted for the proper funding methods to ensure that their goals are achieved.
Great. Thanks, Ashley. Well, with that, we have about 2 minutes. We ran right up to time. If anyone has any questions, I am checking the Q&A box right now and I don't see any. We'll pause for a second and see if there are any questions that are out there.
We have compliments there from people, not questions.
Okay. Well, that's very kind. Oh, thank you, Ron. Terry or Jean, is there anything you'd like to add?
I think that's it. That's what a great presentation. Wow.
I'm going to take this off screen for a second so I can see your lovely faces.
I got a lot out of it. So thank you, team. Ashley, Andy, Jean, for such a great job. And I learned a lot. So I'm sure everyone else did too. And that's it. So goodbye now for everyone in the Zoom audience. See you at the next program.
Thanks so much.
Great. Thank you, everyone.
Thank you.